Believe it or not, still some big earnings names on deck today. We're looking ahead to reports from Crowdstrike, Chewy, and Dollar General. Here with our trades is Chris Grisanti, Chief Equity Strategist at MAI Capital Management. Chris, welcome. Good to have you with us. Let's begin with Crowdstrike. Shares are up more than 40% this year. Morgan Stanley downgrading the stock ahead of results, citing slowdowns in two key verticals, tech and retail, as well as cloud consumption headwinds. Morgan also sees limited upside in free cash flow. Do you like Crowdstrike or not?
You know, Tyler, it's good to be with you again. And as you know, that's not our kind of stock, but I kind of like the setup for Crowdstrike here. People want to own this stock in this type of tech market, except for AI. Cybersecurity is the hottest area of tech. The second thing Crowdstrike has going for it is expectations are finally low enough, I think, that they're going to be easy to clear. They may be realistic or even a little pessimistic. The metric to look for is net annual recurring revenue, and it's still supposed to shrink about 15% this quarter. So even a smaller shrinkage of, say, 10 to 12%, which is what I'm expecting, should be seen as good news. But the other important factor about Crowdstrike is that the second half, it's back-end loaded. So they need to make their numbers by doing much better in the second half than the first. That's an easy thing to say back in the first quarter, but it gets a little tougher in the middle of August. So we're really going to be looking at how the second half is progressing. If they push back a little further, that's going to be a negative. But I think the setup is good, and I like it here.
Well, let's move on to the next one, which is the online pet food and supplies retailer Chewy, also out after the bell. Shares on a downtrend recently, falling about 30% after the past 2 months as we see signs of slowing discretionary spending. Cats and dogs are just not spending as much. Piper Sandler noting recent weakness in net user additions, but did not. It's seen impressive margin improvements in recent quarters. You think Chewy's a bit of a hairball here, right?
Yeah, you know, I think the post-COVID pet hangover, you know, we all bought pets during COVID, and now, you know, we're not buying as many pets, and we're not servicing those pets as much as we used to. I think that's going to continue. So you're absolutely right, and Piper Sandler's right to focus on the customer additions. That's going to be the stat that people care about. Mm-hmm. And without some growth there, the stock, which is currently at 50 times earnings, I just wouldn't get in front of it. So that's the negatives. The positive thing is that the management's pretty good here, and they've been very forthright about the issues. So expectations are low. But don't forget, last week, Petco reported disappointing earnings. The stock got clobbered. So I think this is still a show-me story that's going to take a few more quarters to work out. I'd look elsewhere. Show me
the Chewy. All right. Don't miss the CEO, by the way, of Chewy on closing bell overtime following those results. That is at 4 p.m. or thereabouts Eastern time. And finally, Chris, we go to Dollar General. It's out before the bell tomorrow. Shares of the discount retailer falling more than 20% since June. The Street keeping an eye on sales performances as discounters are expected to outperform in a slowdown. But Oppenheimer staying cautious, expecting weather-related challenges to seasonal offerings and moving its expectations then to the low end of management's full-year guidance. Your take, Chris, on Dollar General.
Tyler, this is a classic example of how the Street will kind of psych you in and out of expectations. I think I'm not expecting great news from Dollar General, but I expect the stock to be just fine. And the reason is this stock has gotten the expectations beaten out of it. They missed last quarter. The stock was down 15%. Dollar Tree reported last week and got clobbered. This stock was down too. So already lowered expectations mean that mediocre earnings will be met with a big sigh of relief, and the stock could rebound. So I like the setup here. This is a good management company. I think this is the best dollar store out there. And so you can buy it for a 10-year low PE ratio. I think it's a good setup. I think the statistic to look for here is not the earnings. It's going to be the same store sales. And the Street is expecting a mediocre 1.5% growth. I think anything worse than that or better than that will move the stock.
Is this a trade or an investment, Chris?
No, I think this is an investment. I think this is a chance to buy something that could grow for 5 years and get a terrific entry price. They've got store openings that there's still tons of room for store openings, and we like the stock. We own it in size.